Welcome, everyone. My guest today is Odeta Kushi, Deputy Chief Economist at First American, to talk about mortgage rates, affordability, inventory, and more. Odeta, welcome to the podcast.
Thanks, Sarah. It's so great to be here.
Great to have you. And you were just on our HW Plus market update last week, and we're going to get into some of that, but we love going to you and finding out, what the latest is. And today, of course, we're recording this on Tuesday, February 14th. So we got January CPI report. What is the headline number from your perspective from that inflation report?
Really, I think it's, the takeaway for me is that the Fed's job is not done yet. We haven't gotten rid of inflation that easy. And I think, the biggest takeaway for me was that shelter was such a big driver of this month's month-over-month increase. And we know from more real-time data that residential inflation is coming down. And that's not quite reflected in those CPI numbers yet, but they will be. It's a lagging indicator in the CPI. So there is good news to come from the shelter inflation front. And that's something to keep in mind when looking at that January number.
Really important, the shelter inflation, and that includes rent and, what people are paying for mortgages, correct?
Yes, it's owner's equivalent rent and rent as well, which we know house prices are starting to come down, and we also know that rents are coming down as well.
Well, let's talk about some of the things that we're looking for the spring home buying season, which, we're just around the corner from it, depending on where you are, right? We're already seeing some things percolate and some markets that are getting hotter than maybe we would have considered a couple months ago. So let's talk first about mortgage rates. There are so many different variables that go into mortgage rate prediction, but let's talk about that a little bit. Does the CPI report suggest the idea that we're stabilizing on mortgage rates anywhere?
That's the big question, right? Housing is so dependent on mortgage rates, and that's what we're all watching. I think so. When we look at it from a long-term perspective, we're looking at when will the Fed stop hiking rates, and and how long will they keep them high, right? Because once they stop hiking, then they'll probably keep them elevated for some time when we really start to see inflation come down. Right now, that terminal rate's like between 5 and 5.25%, according to the last FOMC projections. So that implies that we've got a few more, two more 25 basis point rate hikes ahead of us, if that's correct. But it's really all dependent on incoming inflation data. I think we could see, some more upward pressure on that 30-year fixed rate mortgage if we get, inflation prints that surprise to the upside. But generally speaking, if inflation continues to come down, we should start to see mortgage rates stabilize and allow for a more stable housing market.
From your perspective, if you're, we know that people can't really time the market, right? But if you are, do you feel like there are buyers on the sidelines, quote unquote, on the sidelines, looking at this going, I've been waiting, since mortgage rates started to get really volatile about halfway through the year last year, I'm really ready to buy. I'm just going to jump in.
I think so. I think there's a lot of, ready buyers who have spoken with their lender, who are calling their lenders, asking what rates are looking like that day. But really the question is, even if you can afford to buy, even if rates have kind of helped the affordability equation for you, can you find anything available for sale in your market, right? Because you can't buy what's not for sale. And we know that inventory has been trending lower. Just looking at the Altos data, right, that just came out, we're seeing inventory continue to trend down. And again, you can't buy what's not for sale. So there might be more demand coming in, but that supply side of the equation is still very, very limited.
Oh, that's so funny. So for our listeners, we just had a cat walk through the our podcast here, which I love. We always get to see extra things about people, and Odeta has some very beautiful looking cats.
Yeah, it's very on brand for me for this to happen, by the way. So.
It happens to us all. I love it. So we're talking about affordability. If you're looking at it, yes, they've come down, but other things, prices haven't. I don't think house prices have come down to the extent that people thought they might, given mortgage rates. What is your take on that?
Well, house prices are downside sticky, particularly when we're talking about existing home prices, because it's a different beast with new home prices, because the seller is fundamentally different, right? It's a builder rather than a homeowner. And if you're a homeowner right now, and even if you're thinking about selling, you've looked at your neighbor's house that may be sold in a situation with multiple offers, and you're saying to yourself, well, I want to get the same price that my neighbor got. And so, rather than sell at a time when you could get a lower price, you just choose to stay put instead. And so, sellers staying put make prices downside sticky. So prices have been really slow to come down. We haven't had a lot of distressed selling, which, as we know, in the last cycle cycle. That's really what pulled down prices. And so we haven't seen a lot of that. And so voila, prices have remained quite high. With that said, we are seeing prices come down from the peak, and particularly in markets that are traditionally more expensive, like your coastal California markets, for example.
Do you feel like when you look at this, do you feel like we can predict by the end of this year we're going to see, home prices come down X amount, or is it just really hard with the inventory? I feel like that throws a wrench in the whole conversation.
It does, because the lack of inventory provides a floor, right, for how low prices can go. What I will say is that, over the pandemic, we sort of had a national housing market, which is, crazy to say because we're always talking about how real estate is local. But we really did. Everywhere you looked, in every market, there were multiple offer bidding wars and prices getting bid up. But now it's really back to being local, right? We're seeing, markets in Southeast Florida that are maybe a little bit more resilient. And then we're seeing, places like San Jose and San Francisco where prices are coming down. And so it really will depend on where you are and what those supply and demand dynamics look like in those markets.
I think the other thing is if you're looking at comps, it just really throws things off because it's like, oh, it's down 37% or it's down this huge amount. But if you look at maybe, pre-pandemic levels, which I guess it's hard to say what is normal. What should we be looking at for the normal, or what's our baseline? In your opinion, what is that? Is that 2019 prices? Is that, at some point 2021? Like, what do you look at?
It's really hard to say, what is normal, because then you have to decide what's normal for inventory, what's normal for demand. 2019 certainly was more normal than 2020 and 2021. But even in 2019, we had a lot of demand, rates were still quite low. And so it's hard to say that was normal when it comes to prices. I think what's normal for prices is what's supported by the fundamentals. Is the housing market overvalued? Are we in a situation where what people can afford to buy is less than the price of the home, in which case that would be considered, an overvalued market. And so I would like to see a situation where house buying power, or how much people can afford to buy, is in line with what prices are in each given market.
Now you have current homeowners who are in a really great position, most of them, right? They refied into a pretty sweet rate.
Yes.
And they've got lots of equity. And so they don't have a lot of incentive necessarily to list or to move up, move down, whatever. First-time home buyers are making that calculus looking at their rent. And I think this is where it gets really tricky. So in some areas, so I have two kids in New York City. New York City rent has gone crazy, kind of coming off those, lows we saw in the pandemic. And, people are seeing monthly rent increases that are just crazy. And so it's really, I know that's a very specific market, not really indicative of a larger trend, but I do think, figuring out where you are in a local market and rent versus buy is really tricky right now.
It absolutely is. And, we've done some research to try and make this easier for people, but it's for that potential first-time home buyer. If you can afford to buy, how should you be thinking about this, right? And from the rent side, it's pretty easy. You just, you compare how much you're paying in monthly rent. But then when you're trying to determine how much it will cost you to own, it's not just the principal and interest on your mortgage. It's so much more than that. It's the maintenance costs for your house. It's, maybe like an NHOA or whatever you might have to consider in those fees. But the other piece that you need to consider is the equity benefit from being a homeowner, right? Because when you're renting, you'll never be able to gain that equity benefit or that house price appreciation that you will as a homeowner. That's really tough to do right now because you're thinking to yourself, well, I don't know what I could benefit. I don't know what the outlook looks like for house prices. So, if you look back in time, the historic average house price growth is about 3.8%, a long ways from the double-digit house price growth we've seen over the last couple of years, but still pretty healthy growth in house price appreciation. So we do that calculation by factoring in what is the historical appreciation to really be more informed as a potential buyer, what makes more sense to rent versus to own. And then, of course, there's a lifestyle piece, right? We're always talking about the financial equation, but are you ready to buy a home? Does that kind of match your lifestyle? Is that where you want to be? And so there's always that lifestyle decision as well when it comes to making the decision to buy or rent.
One of the calculations you have to do if you're going from renting to buying is property taxes. So I've lived a lot of my adult life in North Texas and in a county that has some of the highest property taxes percentage in the whole country. It's crazy. So people are like, oh, Texas is great. No state income tax, no this, that. Well, I tell you what, they do make it up somewhat in the property
Yes.
taxes, which can be crazy. And then you think about the home equity that, the fact that people's home equity has gone up or what their house is worth. And property taxes can be something that then becomes a detriment as, if home prices keep increasing, especially so say in North Texas, we have had a pretty big run up over the last couple of years in a way that typically this area doesn't do, right? We're not a coastal area. We just haven't had that kind of hot thing happen before. And so now you're seeing people are locked into some pretty amazing property taxes. What is First American? What do you look at? How do you factor that in?
So we do factor in property taxes to that rent versus own calculation on a market by market basis. And to your point, you've kind of have to try to figure that into your calculation as it stands today, and maybe bake in an expectation that that will rise over time, and make sure that you can handle that payment. And obviously a lender will help you make that determination as well, right? What your debt to income will look like and what you can afford. But certainly taxes are a big part of that equation of renting versus owning.
They really are. And I think that if people are going to, like I said, most homeowners are in a really great position. So we haven't seen, there was that whole like, oh, we're going to have a bunch of people who are going to come out of forbearance and need to get out of their, have distress selling or whatever. We have seen none of that because of just other economic factors. But I do think that the property tax situation could be one of those things to keep an eye on. Not that I expect some sort of tsunami of, foreclosures or anything based on that, but tax foreclosures are a whole separate thing.
They are a whole separate thing. And, on the foreclosure piece, you touched on something really important. We haven't seen, even with foreclosures going up, and they have a little bit, they're still below the pre-pandemic normal. And part of that is because, if you do need to sell, you're just sitting on a ton of equity, right? And so you kind of have the situation where you don't want to sell, but you still can walk away without having to foreclose on your property. But also the labor market, right? It's when we're talking about a foreclosure event, you typically need this dual trigger. You need the inability to pay, which could come from potentially, loss of a job, loss of a spouse, and also insufficient equity in your home. And we're in a situation where not only are people sitting on a ton of equity on their properties, but they're also, employed because the labor market's been so strong. Now, if we start to see, the labor market start to struggle and prices come down, that's where I'd start to be a little bit more concerned. But I think just given the equity cushion that we have in today's market, I absolutely don't anticipate a foreclosure wave.
So we've talked about existing homes. When you look at the new home market, what is the outlook there? And can we expect that to sort of come in and save the day here on inventory?
Yeah, so new home inventory is making up a larger share of overall inventory, actually a historically high share of overall inventory. But a lot of that inventory is in the process of being built. So it's not yet completed. It's that, builders have had to face a lot of supply chain headwinds over the course of the pandemic. And so has sort of slowed them down. And so a lot of this is in the pipeline, but not yet completed. I think the interesting thing about the new home side is, builders have to adjust pretty quickly because they want to they want to sell that inventory. They can't stay put like an existing owner can. So we're seeing, price cuts in the new home market. We're seeing builder offer, incentives in the new homes on the new home side. And that seems to be working. There seems to be some demand elasticity when you see prices come down or you're offering, some of these quality features on a home, you're seeing buyers sort of come back. But, right now at the high prices, it's tough for the new home side. You can definitely tell the new home sales has been kind of in a recession, if you will. But if the price is right, I think the buyers will come back, and we see that in the data as well.
Well, and a lot of the new home building has been in the multifamily area, right? So not something that we would consider helpful for the single family market, although obviously that helps on the rent side and the rent index side, but not a lot of that is single family.
Yeah, yeah. So on the multifamily side, we talked a little bit about rents coming down. Part of that is the supply side of the equation. We're getting a lot more units coming to market, new supply. And then on the demand side, household formation, rental household formation specifically slowing is contributing to kind of demand pulling back as well. And so, again, demand down, supply up, prices start to adjust downward.
Are there any pockets of the country where you're like, oh, this is a really great, this is an interesting market to keep an eye on, either from the standpoint of like you mentioned San Jose and prices finally starting to fall there, which is, welcome news, but like how far would they have to fall for the average person there on an average salary to be able to afford it is another question. Are there parts of the country that are like, this looks like the new Austin, or this looks like the new, hot place, or conversely, places that you're like, they really didn't have a huge run up, or they're not going to fall a lot, so they might be a safer bet.
Yeah. So, when we think about affordability, because you mentioned San Jose, it's obviously prices are big, mortgage rates are the other factor, and incomes would be the third when we're talking about the affordability equation. So, how far will prices need to fall? Well, it depends on what happens with mortgage rates and incomes in that market. When we look at our affordability metrics, as I mentioned, clearly some of the coastal, California markets are where it's least affordable, but there are markets that stand out as more affordable. Pittsburgh is one of those markets. Oklahoma City continues to pop up on our more affordable list. That's, these are places where a potential first-time home buyer has more affordable inventory available for sale for them in those markets. And so, these are markets that I'm watching, but when I take a step back and look at migration patterns and where people are moving, it's still those Sunbelt markets, it's still these major Texas metros where people are moving in because, sun, relatively more affordable, and there are jobs. And that's really the recipe for more net in-migration to a market.
You mentioned Sunbelt. Phoenix stands out. It's been a topic of conversation for years now. So first of all, they were sort of the cradle of the iBuying movement, and then has seen some fall off there. There are also a lot of talk about people buying investment properties there for short-term rentals. What do you see in the Phoenix market?
We're starting to see the Phoenix market slow down, prices starting to adjust downward. Again, it is one of those markets that saw a ton of interest from out-of-staters moving into Phoenix because on a relative basis, it was more affordable and certainly, an attractive place to buy. A lot of sun there too. We can't neglect the weather, of course. And so still a lot of interest, demand coming in, investors coming in. I've talked about this a lot, which came first, the chicken or the egg? Did investors come in because they saw prices rising or did prices rise because investors moved in? But we are starting to see, prices start to adjust down in that market as well as demand sort of pulls back and supply catches up.
Really interesting. You mentioned Oklahoma City. I moved to Kansas last summer from Dallas. And so I drive through, going back and forth a lot. Our HousingWire office, our sort of hub, although not a lot of people are working from there, is Dallas. And, I still have family in Dallas. So I drive through Oklahoma City on the regular. And it is definitely changing. Another city like that, my son moved to Tulsa about a year and a half ago on a remote work incentive that Tulsa had for people. And it is just shocking when I was looking at housing in both of those markets, the number of houses you could get that you would want to live in that start with a 1, like 120, 130. And you just go, wow, but the whole, calculus there is, can you get a job there? Or like, in the case of Tulsa, and I actually believe Oklahoma City also had that remote working thing. They're trying to lure people who are like, listen, you can come and, afford a great lifestyle here while, we don't necessarily have that kind of job for you. But if you already have that job, and I think that, I don't even know if you would call those like tier 2 cities or like what kind of tier those cities are on, but they're interesting in the sense of like, you can build a life in a place like that.
And we saw that happening, obviously the ability to work from home over the pandemic accelerated some of these pre-existing pre-pandemic trends of moving out to suburbs, exurbs, and even leaving your market to go somewhere more affordable. But now the ability to work remotely really kind of pulled forward some demand, because if you were considering another market, a more affordable market where you can buy more home with that same salary, we saw that happening quite a bit. And I don't necessarily anticipate that. I think that trend is slowing, obviously, and a lot of employers are calling for employees to come back into the office, even in a hybrid situation. But the trend is still more work from home, which I think will allow more movement to the exurbs and the suburbs and to more affordable markets. And then, of course, the commercial demand will follow. We've done some analysis looking at, what happened to prices for retail and office space and even, apartments. And you kind of see that following the where people have moved. So you're seeing a lot more demand for some of these, for retail space and offices in the suburbs where folks moved to over the pandemic. So I think that's a really interesting trend to keep your eye on is, what's happening in again, suburbs, exurbs, and more affordable markets.
Love to move our conversation back to mortgage rates a little bit and looking a little bit farther out towards the end of the year. You had talked about on the market update that we did that is, you have seen that stabilization around 6%, or you feel like that is going to be the new stabilization point. I've talked with our lead analyst, Logan Motoshami, about the idea of a mortgage rate lockdown, where people who are locked into such a low rate when mortgage rates have gone up so much, they're just disincentivized to list their home, right? Because then they're going to have to buy another home. And, we've been looking at does that still hold true? And he's not convinced that is a thing. From my perspective, I'm like, in the 5s, do we feel differently than in the 6s? The 7 seems like something that really would just, we've seen it over the last year, it locked down, the mortgage market. From your perspective, what do you think about that? And what is the level that people are going to feel comfortable at?
Yeah, so I do believe the golden handcuffs of low mortgage rates are very real. Like I said, the bulk of inventory is existing home inventory, and so we're really reliant on existing homeowners moving in order to get inventory to move up. But unfortunately, it's something like 84% of existing homeowners with mortgages are locked into rates below 5%. Which is a pretty substantial amount. With that said, one stat that sometimes goes unnoticed, but I think is important to mention, is that about 42% of owned homes are free and clear. In other words, they don't have a mortgage associated with them. Now, these tend to be older homeowners, homeowners that have purchased their home many, many years ago and have paid off their mortgage. But this is a potential pool of homeowners that could free up some inventory, right? That could decide that they're finally wanting to make that move, or maybe they want to retire elsewhere and give up that home because they're not rate locked into the home. So I do believe that they can alleviate some of this concern over the rate lock-in effect. But what the threshold is to get existing homeowners to move is tough to say, but I imagine, below 6% would certainly help.
It's funny how everything is relative, because obviously when mortgage rates moved from in the 3s to the 5s, we saw some panic there, but it was really when they shot up into the 6s and then the 7s where it just was too fast it went up too fast in a short amount of time.
And that's the key, right? Because prior to this whole thing happening, we were saying, well, historically, mortgage rates approaching 8% is very normal, but it's not about that. It's about how fast it changed, right? And how dramatic that shift was from below 3% to, 7%. It seemed to happen virtually overnight. And the fact that prices couldn't adjust down fast enough, that's really what the problem was in terms of affordability. Affordability declined 60% year over year. That's pretty dramatic.
That is really dramatic. And, for people like us, so we're in the weeds every day, right? We're thinking about housing, we're reading about housing, and we understand the nuances and the shifts. But if you're your typical homeowner and, you pay attention about 2 or 3 times a year, you might still have that whole thing. Like you said, I want to get what my neighbor sold for last May. They're not keeping up to the latest things. And I think that perception is one of the biggest problems.
Yeah, I mean, sellers want to sell at yesterday's prices. Buyers want to buy at tomorrow's prices,
Right.
and unfortunately, they'll have to meet in the middle because again, buyers are anticipating that prices will continue to come down. So there's a lot of kind of wait and see, and then sellers are still hoping to get what their neighbor got. And I do think we're at a level of acceptance, right? If we're talking about stages of grief of higher mortgage rates, we're sort of at a more at everyone's sort of understood. I don't think we're getting below 4%. Certainly not anytime soon. And so once you've sort of accepted that this is the new reality and prices will adjust, then I think it'll allow for some housing market stability. And we're starting to see that in different metrics. Higher frequency mortgage applications have started to increase, pending home sales increased. Part of that is seasonal, but part of it is demand slowly coming back as mortgage rates have stabilized.
So, for all of our listeners who are working in a mortgage company, they're in real estate, they're in title, they're in appraisal. It's been a tough go last 6 months. And, what is your forecast for when do things get better this year? In 2023, we're hoping, where's the silver lining here?
I think the silver lining is if inflation continues to come down, as I think most, economists are predicting, we'll start to see housing market rebalancing continue into this year, and we'll start to see some stabilization in the second half of the year. It's really dependent on mortgage rates, the path of mortgage rates, but I do expect that we'll start to see some stabilization this year in the housing market.
And stabilization hopefully, translates to people buying and selling homes. That's what we're all about.
Some thawing, right? We were frozen at the end of 2022. We're starting to see, the early shoots of spring home buying season appear. And I do think that we'll continue to see that throughout the year.
Well, Odeta, thank you so much for being on. Great to talk to you. And of course, we will see you again soon. You're a frequent contributor to HousingWire, and we often see you at other conferences as well. Really appreciate you taking the time today.
It was so great speaking with you, Sarah. Thanks so much.